because the marketing times are longer. That's oversimplification, but we're lucky in Texas that we're not seeing 30 and 40% less, but we're seeing a little bit off on some of the appraisals. And so your LTV will often, if you're buying a property at a great deal at foreclosure, the LTV that the bank will use most likely will be based on the cost, not the appraisal, even if the appraisal is higher. So it's going to be a new game. Experience is essential. How many of you remember the days when we would see the best sheetrock or the best cabinet maker, the best whatever, and 5 or 6 years he started his own home building company, and some did very well, but I think that that's going to be harder to do. You're going to have to show that you have the experience overall in business to make a project happen, and that you have the commitment to go forward and make that happen. Positive financial performance. We all know the tax games, but you're going to have to be able to show that your company and you personally paid your bills and made things happen and could make money. It won't be that constant rolling that we've seen for 10 years, even though that was good business for our economy. Location, I don't have to tell you all about that. We talked about use of risk mitigating programs. You'll see more of that. Or you may be asked to have additional collateral or cash reserves. And maybe the additional collateral can be used for cash reserves. And let me talk about that a little bit, because in the old days, if we had a 20% loan to value on a big piece of property and the customer could pay the interest, we were like, wow, that's great. That's performing. That isn't how they're interpreting the definition of a performing loan anymore. Performing means if you contracted to take down 5 lots a month, you better be taking down 5 lots. Even if you're taking down 4 lots, it's suddenly not performing as the original contract was constructed. So it's those little nuances that the regulators are not using bullets anymore. John, they're coming in with the great big, what do you call those, rocket launcher things, and it's harder to escape those than it was those single bullets when the regulators were around in the 80s. It's not all doom and gloom. I have a lot of customers that can meet all these requirements, and the good news is a lot of banks save their capital and have those capital ratios that are necessary. A lot of the new banks started with more capital than they ever could. It's just different, and we're going to have to treat it differently. So what should we do? Well, I think it's important that you have meetings like this and you stay informed on at least what we know at this time about the regulations. Know that it's going to cost more a little bit. I'm not talking about tons more, but it will cost a little more. For a bank my size, I figured it would be about $300,000 to $350,000 a year to implement some of the new regulations we anticipate. And even though there's a Consumer Financial Bureau of Protection, can't get the acronym right because it doesn't roll off your tongue, and we expect a lot of new rules, what we see happening is the Federal Reserve came out with new rules on overdraft protection. That started last Sunday. That's expensive. That was one of the things we thought the Consumer Bureau would do, but all the regulators right now are jockeying for who's on top of the mountain. Who's the toughest regulator? Who's the best? So they're coming up with rules, and they have that authority before the Protection Bureau even has a chief or is in business. So, interesting world. Learn about guarantee programs that can help you in all parts of this great state or the country to help the bank mitigate their risk and mitigate that cost of capital perhaps, or the capital against the ratios. And realize that it's a new game, but it's one we all know how to play, and we can make it, we can be winners. There you go. So.
Thank you all very much, very informative. Any questions? Gary?
I wanted to ask the panel, what
I can tell you what they're expecting us to do. Now, when you say debt service, are you talking about amortization or just interest only?
Both.
Okay.
Whatever they.
Again, we get back to the way they're interpreting what is a problem asset, if you will. And bankers around the country have come up with the term performing non-performing loans. So if it is being debt serviced, but the real estate value has dropped to, let's say, 110% or 100% or even 90%, but you're still paying the debt service, it's non-performing because that's an identified weakness. So guess what? That makes my numbers look bad. I'm being told on the one hand to work with you, on the other hand I'm being told, you know, this is a problem loan. So I have to classify it that way, and I'm gonna wanna get that out of the bank. So I'll either want you to put up more collateral to make the loan to value better, or pay it down, or something to get it back in line so I can call it a performing loan. And that's the reality. And the workarounds, the forbearance, it's going to be much tougher to do. We're under a great deal of pressure to go ahead and deal with the situation. And of course, my personal opinion is that's hurting the economy at large. You'll see banks, there's more of a push right now on other real estate owned to get rid of it at a much lower price than we all believe it's worth, and that even a recent appraisal like 2 weeks ago thinks it's worth, because they don't want it on the books. And they aren't looking regionally to say, well, Texas isn't the same as Arizona, California, whatever. The mindset that's coming down from Washington, and this is what I hear from people in the field, is you're all just the same, it's just coming a little later. And so we're gonna take care of the problem now. We have to counteract that, and we'll try to do it, like I said, with risk mitigating programs. And we're going ahead and working with people. I mean, that's what your bank wants to do. We have relationships with people. We don't want to rip the Band-Aid off. But the mood is to force banks to do that, to call them non-performing, which then causes your numbers to be higher against capital and causes other issues. So it's a tough environment. Yeah.
I think the LCC seems to have been just turning their head the other way, and now do you see more tendency for them to enforce that? And if so, do you see a massive exodus of a lot of loans out of the bank? I mean, from a debt service or an interest perspective, you know, LIBOR plus loans, I mean, that's a great place for a borrower to be now, and there's not a lot of incentive to come out of the bank if that is the environment, the interest rate environment that we're in. Do you see more of a push for taking those loans out of the bank going forward over the next year?
You mean from the customer standpoint?
Well, from the bank standpoint.
It really depends. You know, I'm a high CRE bank, so I may look at that because of my concentration levels. I'm not saying I'm doing that, but it all depends on the bank's own profile. And again, you've got a lot of de novos with a lot of capital that will look at those good loans and will structure them differently, and it may be a good decision for the consumer to move the loan. I generally, the truth of the matter is when a bank wants you to move a loan, it's hard. There must be a problem with you moving it. So I don't see anybody, the only way again we make money is to have loans on the books that are performing. I just think that we're going to have to spend a lot more time justifying each loan and maybe asking for more appraisals during the course of the time. Something else to help us justify keeping it